as cryptocurrency investors, traders, it behooves us to look for new tools, or, well, not always to look for new tools, but to develop methods of analysis that can help us get a good bead on where we think price is going to go and give us objective trading signals. It's the entire purpose of everything that we do. And we touch on a lot of factors. What's really cool about Bitcoin, I mean, I think the data is more relevant with Bitcoin, but what's data that we don't have from stocks and other financial assets, for example, we have on-chain metrics, and these can be really powerful when we look at where price might go, right? It helps us determine sentiment. It helps us determine what the miners are doing. When miners are feeling the squeeze, for example, there's a lot of really, really good metrics, like is money flowing into or out of exchanges? We can tell that from the blockchain. How long are UTXO sets being held? Are new coins moving? How many people are hodling Bitcoin? All of those metrics are really quite bullish, right? We've covered a lot of those before, like the quantity of wallet addresses that are holding 0.1 BTC, that are holding 0.1 BTC, the amount of Bitcoin that hasn't moved in such a long time, indicating that hodlers are hodling, right? And then we combine that with the fundamental analysis of what's going on in the world, the knowledge the currency crisis is coming, the knowledge that Bitcoin is a better store of value than fiat money, and the Bitcoin has a real chance here to not only make the world a better place by providing at least a base level for a more fair and equitable monetary system, because the fiat system is just too far. There's no way to save it. It is not a good system. It's a bad system. It does not work. I mean, okay, let me put it this way. It works. It's the best thing that we got, but we have not been able to fix these problems. So I am not an individual that is comfortable with a system that is just always going to be this broke. No, I think, and this is an argument I get from a lot of people. Like, look, man, look at all the wealth that that the fiat money system creates. It does. It creates a lot of wealth, creates a lot of prosperity, but it always crescendos into the situation where it crashes and burns. And this is the cycle that we've gone through as society. Obviously, we have way more technological innovation now in our modern era than we did, for example, back when the Greeks did this, back when the Romans did this. All the different times throughout history that fiat nations have created a fiat currency, developed a little bit of an empire, kind of controlled the world, and then crumbled and dissolved. And that's just what we know in recent history. Who knows what we don't know in older history? But anyway, certainly a cycle that you can study in history. It always ends in a currency crisis. It always ends in some form of societal collapse. And I'm not okay with that. I'm not okay with that being the status quo. I'm okay with asking the question. I'm okay with looking for the solution. Like, hey, if we build a better monetary system, which is kind of the backbone of every advanced civilization, maybe we don't have to tear ourselves apart eventually when wealth becomes too unequally distributed, or when it becomes too much civil unrest, which is all sides of the same coin. If you guys want to know why there's civil unrest, in, particularly in the United States right now, if you guys want to know why there are so many problems in the United States right now, and really around the world, it's really not the symptoms, right? As individuals are saying they are. These are, individuals are right now popularly reporting symptoms of an underlying problem, which is a corrupt and deficient monetary system, right? That is the basis for everything. People don't really get upset unless the issues affect their livelihood, right? Which these issues are. The Fed's monetary policy is directly contributing to everything, to all of the civil unrest, to all of the problems, to the unemployment, to wealth inequality, to inflated asset prices, to less purchasing power for regular individuals. These are easily predictable outcomes for what the Fed is doing. Like, when you recklessly increase the monetary supply, and when you allow your fiat currency to really be devalued, and we can add more things in, like we purchase goods and services, and we export these notes all over the world. Those are going to come home to roost. That's when we're going to see inflation. All of these things are very, very predictable outcomes. But getting back into mining. Sure, I was going to tie that thread in somehow. But anyways, one interesting metric about watching on-chain good data can be pulled out of measuring on-chain data, right? So we're going to be touching on one factor to determine sentiment, and that is a miner capitulation, right? That is, Are miners feeling the squeeze and selling their production reserves as a result of Bitcoin's price or economic situations, or maybe increased energy prices? Or if they are confident in a bullish trend and holding for higher prices, right? So this is a tool that I don't really think is very well known. Obviously, these individuals who wrote this article are a little bit promoting of it, but it's okay. We're gonna look at it. It's an algorithm. I like it. And I'm going to see if it can give us some valuable insight into the mood on the ground at the world's crypto mining. We are live here at Crypto Mining. To go over to the Sichuan district province in China. Okay, so there's this company called ByteTree Analytics, and they have what they call a miners rolling inventory indicator, MRI for short, right? And as we can see here, let's see what the sticker says. MRI measures the changing Bitcoin inventory levels held by the miners. If an MRI is above 100%, it means that miners are selling more than they mine and running down inventory. Conversely, an MRI below 100% means the miners are holding Bitcoin. So bigger number is bad because they are selling more BTC. Lower number is good because they are hoarding more BTC, right? I say as an example, over a 6-week period, miners generated 76,963 new Bitcoin, while first spend saw 78,342 Bitcoins join the network. Therefore, 2% more Bitcoins have been spent than have been mined. And this would describe, or MRI would describe this at 102% because more has been sold than has been mined. All right, so it's a relatively simple concept. As I said, it's the amount of Bitcoin that miners spend from their inventory than they actually generate. It's divided by the amount of Bitcoin generated from mining during the same period. And they multiply by 100 to get a nice percentage. So if we take, for example, the last 5 weeks of miner inventory data that ByteTree here has compiled, miners have spent on average 6,361 Bitcoins per week. And they've mined an average of 6,713 Bitcoins per week. All right. So that is, this generates an MRI of 94.7%. And that indicates that miners have been selling less Bitcoin than they have mined over the past 5 weeks. So miners are hodling, or they're building up their reserves, right? They're not interested in selling at these prices. Okay. Why would they not want to sell at these prices? Price is pretty high on Bitcoin, relatively speaking. It is above its cost basis, its fair market value. Well, you would certainly hold on to your Bitcoin if you felt the price was going to appreciate and you could sell at a higher price. You can see this happen in the order book all the time. You'll see a liquidity come in and liquidity will jump up higher. And that's because algorithms or traders are detecting that we have an opportunity to sell at a higher price. Why wouldn't you? This is where this article gets interesting, because this is how I would easily interpret the data as we've come so far. If miners are hodling Bitcoin, that is bullish because they would want to sell at a higher price. And if they are selling more Bitcoin, then obviously that is bearish because there's excess selling pressure coming onto the markets, which moves price down. And it also just indicates that miners want to sell. Like if miners want to sell, man, maybe you should be selling. Okay, sounds pretty simple. But as I said, at first, it would seem to me that an MRI below 100% is bullish, right? That means that miners are selling less than they spend, since miners would be hodling if the MRI is below 100%. And if MRI is above 100%, that would be bearish because miners are selling it off. But ByteTree conducted a study here which seems to suggest that the opposite is true, right? And they did this by trying to calculate profits. Here we go. Here's the source right here. This one. They did this by trying to calculate the profits from trading in a variety of scenarios given the MRI data. All right. So they looked at scenarios where one trader holds when the MRI was bearish and one trader sold when the MRI was bearish. You know, for example, they just tested out different strategies. Like, what if I buy when it turns bearish? What if I sell when it turns bullish? So just kind of testing almost exactly like we do, like an objective indicator strategy. And they also calculated the opposite, right? If one were to hold when the indicator is deeply bullish and sold when the MRI turned bearish above 100%. So what they actually found out in this analysis seems to be pretty counterintuitive, contrary to what I would initially think, or what I think anybody would think, looking at this. Like, oh, you've got an indicator that tells you when miners are selling more than they're selling more than they're mining. Okay, if they're selling more than they're mining, that's probably bearish. If they're holding more, if they're holding what they're mining, that's probably bullish. But that does not seem to be the case. Holding Bitcoin when MRI was bearish, meaning miners were selling more than they bought, led to greater returns. And if you held Bitcoin during periods when MRI was bullish, that led to losses, right? So counter trading the MRI indicator, these guys found, beat the buy and hold strategy long term by selling Bitcoin when the MRI drops below 100% and hodling when the MRI turned bearish. So again, selling when miners were selling more than they were mining, and holding when miners were holding when they were mining. An interesting takeaway from this is why, excuse me, or at least why they think this is the case, right? Right. So why is the indicator, what is this counterintuitive nature to the indicator, right? So they present this kind of following this theory. Why do we see this sort of price behavior based on the miners rolling inventory, right? Essentially, miners decrease the amount of inventory that they are selling during times when market liquidity is lacking, and increase the selling of their inventory when there is abundant liquidity. So kind of contrary to what you would think, right? Because miners are keen to optimize their profits, they also have a vested interest in preserving and not tanking the Bitcoin market. So miners sell more Bitcoin when there is more liquidity to absorb that Bitcoin. If there's not, like you guys know this from trading low sats, perhaps, if there's not a lot of liquidity in the market and you've got a relatively large bag and you market sell, you are potentially going to move the market down quite a little bit. Conversely, if you are, if you put a $30,000 market sell into Bitcoin, XBTUSD or BTCUSD on Bybit, you're not really going to move the market at all because there's so much liquidity to absorb. So miners are being polite here. Like, they care so much about the Bitcoin network that it seems that they wait when there is excess liquidity to absorb their sell side flow, then selling when there is reduced liquidity, which would negatively impact the price of Bitcoin. So miners sell more Bitcoin when the market has plenty of liquidity and can handle the selling pressure, and they pull back when they see that the market is lacking liquidity and would be damaged by a significant sell-off, right? So in other words, the MRI, at least as they describe it, is a good proxy for liquidity in the Bitcoin marketplace. Not necessarily a directional bias indicator, but a proxy for liquidity. And liquidity is a good proxy for how healthy the market actually is. Therefore, if we really kind of apply their back testing here, then an MRI above 100%, we could consider bullish. Like, should we hold our positions? Since it indicates that the Bitcoin market has abundant liquidity and demand, which can often lead to good breakouts and continuation of price appreciation in market cycles. And the MRI being below 100% is bearish because it indicates that the Bitcoin market is lacking liquidity and demand, which means indecision, which means if individuals come in and start selling high very quickly, got a problem. So you guys can check out ByteTree has a pretty interesting data terminal here. I'll leave a link in the description below. Presents some of these on-chain metrics. You guys can also go check these out at Glassnode if you want. That's what I utilize. And you guys can kind of observe this if you want to and reach your own conclusions. Always trying to present you guys with new information and data. And the nature of Bitcoin's transparent and public blockchain data, again, as I kind of said at the very beginning, gives us the insights for all sorts of metrics that individuals can base and build their strategies on. So I really do. I'm a data guy, so I find stuff like this fascinating. So just bringing it to you guys. And I'd be interested to get your thoughts and opinions on this as well.